Welcome back to another episode of the Pure Property Podcast. Now, you'll quickly realise that my partner in crime, Matt, isn't with me in this episode. He has decided to take some time off and, have a well-deserved holiday for a few weeks. So the team at the Pure Property Podcast have got some exciting episodes lined up for me, and I have some exciting guests that will be filling the gap while Matt is away as well. So in the coming weeks, you will get to see and hear from the guests that we will have on, and they will be able to bring some extra insight and some valuable info to the podcast. But enough of that, let's move on to this week's episode. So the dust has settled since the Chancellor of the new Labour government, Rachel Reeves, gave her autumn budget statement. So today I'm going to give a debrief of my thoughts about how this could affect the property market and what it potentially means. And I'm going to break down the key points in the autumn statement that are related to property and go through those. So, starting off with the announcement of £5 billion to be invested into housing. So, I think this part of the statement shows the Labour government's thoughts and desires to really increase the housing supply to help with the situation that we find in the UK, that there is a lack of supply. There has been a housing crisis for many, many years now, and that announcement of the £5 billion going towards housing is them saying, look, we realise that, and putting some money into that to try and fix the problem. Now, what does that mean from a property market or property investment point of view? Well, that means there is potential for long-term growth opportunities. Now, with increased housing supply, which will, of course, it's not going to be an overnight thing. That's going to be sustained over their years in Parliament. So over the next 5 years, that will lead to different opportunities. So you'll have different developments becoming available, which can help investors, give them opportunities to invest. There'll be potentially new areas to invest into as well, with the funds going to help build out certain towns and or cities. And we also know the opportunity here is, from an investment point of view, is with new houses being built, those areas where that is predominantly taking place, the property market there will benefit, because we know new developments will usually come at a premium price, and then the rest of the properties in that area piggyback off of that. So we see prices naturally lifting. So, this influx of money to produce housing can have a positive effect. Now, with that staggered over their term in Parliament, if that is executed correctly, that's going to be filtered through nicely, which then should hopefully mean it's a nice steady flow of properties, which can lead to, a nice steady flow of house price growth. That will help bring in, a good amount of supply, and there's still going to be a lot of demand there. What they're going to do with £5 billion realistically isn't going to fix the supply and demand imbalance. So for anybody thinking, oh no, there's going to be a saturated market, there's going to be lots of supply, that's just not the case. And also you have to remember that new housing coming in isn't going to be just landlords and investors buying that up as well. So there will still be a great opportunity, as I said. So you've got potential for nice long-term sustained growth. You've got nice healthy supply within the housing market. And also, the opportunity to be buying in these areas where that housing is being built. If you're in and around those areas, they're probably going to be focusing on areas where they want to lift up the local area, and put a bit of regeneration in there as well to provide those homes and provide the amenities that go and that are needed along with that as well. So on to one of the next main announcements, which is related to the property market, and they announced that the rates of capital gains tax for residential properties isn't going to be changing. So look, there's not really too much to say on that, other than it just helps to bring some stability for investors and landlords that are holding assets that are potentially looking to sell in the future. It just means long-term investment strategies can remain stable and just helps with forecasting. So look, that announcement doesn't really make or break the property market. It just leaves things the same. I think that did come as a bit of a surprise to people because, there's a black hole, as Labour keeps saying. So I think a lot of people within the property industry were thinking, well, look, they're going to be, raising taxes here, there and everywhere. So that means the capital gains tax is probably going to rise. And, if there's landlords looking to liquidate their assets, exit the market, they're the ones that are going to get punished for that. And that could have seen, if that was going to take place, that could have seen a mass exodus of, maybe older landlords that were close to exiting. And when I say older, I don't mean by actual physical age. I mean by length of time in the market as a landlord. But yeah, you may have seen those landlords coming to the end of their term as a buy-to-let landlord, looking to exit before those changes come in. But the good news is that is unchanged, so it remains stable, and it means forecasting and planning ahead is definitely a lot easier, which is good. Okay, now they announced the housing target for the next 5 years while they are in government, and they are aiming to build 1.5 million homes. Now, that is to help them with the rise in demand that is out there because there's low supply. And I think, look, if we look on what that means in terms of how that can affect the property market, I think if they were to deliver that, again, it's similar to the £5 billion of funding that they want to, use for housing. It's going to be spread over a long term. It's going to be like a trickle-in effect and slowly brought in, houses built over a number of years. And look, that can only have a positive impact on the property market as a whole, but also, from an investment point of view, again, you're going to see new houses coming to market, will help with local areas that will, naturally lift up local prices, potentially. And it will just help, give a balanced property market still. Of course, if you're a buy-to-let investor and you're holding a property now, you kind of selfishly want a bit of an imbalanced property market where, supply is so restricted and demand is so high, because that usually leads to house price growth. But, there are other factors which do stunt that, which we have seen recently, like affordability levels. Again, so this depends on where you're investing, but, overall supply and demand usually leads to house price growth. So selfishly, some investors may say, I hope they don't hit that target. But look, if they can hit that target, as I said, it's not really going to put a massive dent in the imbalance massively. It will help, but it will help stabilize the property market as well. So over the long term, the property market will stay stable. It won't be as volatile at certain points potentially, which again, as an investor, helps you forecast a lot easier. If you've got a nice stable property market where, rents rise at a reasonable rate each year, and so do house prices, in line with, the economy, inflation, wage growth, etc. It becomes a nice, predictable market to a degree. So, you can see what your property is going to do. You can see how it's potentially going to perform. So, yeah, that is potentially a good thing. Now, before I move on, do I think they're going to be able to hit this target? So, yeah, that is a question that I've had. Do I think the Labour government will be able to hit their 1.5 million housing target? No, is the short answer. I don't think any party coming in, or whether that was Conservative staying or any other party for that matter, would be able to be reaching a target of that level or similar, even slightly lower, because it's a very difficult landscape out there at the moment. There's a lot that needs to be changed within the property market that would enable houses to be built quick enough to be able to provide that many sort of homes. The planning system needs to be looked at in general to help developers get the planning through a lot quicker. Less obstacles, less red tape. I'd say less unnecessary red tape, because of course there is red tape needed to make sure things are done properly, but less unnecessary red tape. And I won't go into too much, but look, realistically, I'll be surprised if they are able to hit that target. And with that, with them missing that target, I do think that the UK will still be in a position in the next 5 years where there will still be a supply and demand issue. There won't be enough supply, and demand will continue to be very high. But that's a conversation for another day, as I can go on and on about that. Now, let's go on to the stamp duty land tax announcement. So this is the last. So save the best till last, as they say. So this is the last main one that I'll go over, because in the autumn budget, of course, there's lots that the Chancellor Rachel Reeves went over, but not all of it predominantly or relative to the property market. But this obviously one is quite a big one, and that's why I saved it till last. So if you weren't aware, the Chancellor announced that they are going to increase the stamp duty land tax surcharge for additional house purchasers. So that's, anybody that owns a main residential home and is buying a second residential home, they'll incur this increase. And buy-to-let investors, landlords buying properties to rent out, they'll incur this increase, and they're due to pay this level of stamp duty land tax. And they're increasing it from 3% up to 5%, so a 2% increase. Now, this is not quite a big thing. This is a big thing. It affects the financials and the viability of some people's investment purchases, even more so for foreign investors, because as UK investors, we're paying the 5% surcharge. But when you are a foreign or overseas investor, on top of the normal surcharge, which used to be 3%, now it's 5%, you also pay a 2% surcharge on top of that. So it will be 5% plus another 2% for overseas investors. That is a 7% charge for stamp duty, which is a lot. So what does this mean? Well, people are going to have to fork out a lot more money when purchasing properties. What impact could this have on the property market? Well, it will make investors less hesitant to purchase, especially in areas where prices are very high. The higher the price, the more the investor is going to pay. So that will limit people buying in those areas. Now, this is what the Labour government wanted to achieve by bringing this in. They wanted less investors buying properties. They want more houses out there for people to be able to buy and live in themselves. Now, this is going to have an effect, and more of a negative effect rather than a positive that the Labour government may be hoping for, in my opinion. So you're going to have, realistically, landlords, investors are, naturally going to shift their focus from the expensive properties to the lower price properties. Some landlords may be put off completely, but majority will just shift and they'll buy lower price properties. So that's one thing that will happen. So you won't kill off the buy-to-let market completely, but what it will happen is the investors that you do put off, they're going to obviously not buy properties, which means less stock. Now, if you're trying to provide more housing for people, you need a balance of houses for people to buy and live in themselves, but also to rent. If you're pushing out landlords and stopping landlords buying more property, that means you're reducing the amount of rental stock on the market, less rental properties, and high demand, because rental demand is very, very high at the moment, means rental prices will naturally increase. So not only will you reduce the number of rental properties out there that will be available for people, you'll then be pushing up the rental prices. So it is going to have a negative effect from that point of view for renters out there, unfortunately. Now, again, also in the more expensive locations, as I said, you're going to have reduced stock because investors won't be buying them. What you tend to find in those locations as well, it's unaffordable for also a lot of people looking to buy. So yeah, it'd be interesting to see how that landscape plays out. But yeah, I do think this is really going to overall not be great. Again, selfishly as an investor, we have to pay more money. Very frustrating. But savvy investors, as I said, they will just adjust. They'll look for cheaper properties. They may factor it in their offers, when they're offering on property. So yeah, it just means in general, there will be slightly less people buying in the expensive areas, but I don't think you're going to kill off people buying second homes, in my opinion. Especially when you're looking over the long term, these investments, because as an investor myself personally, I look to hold assets over the long term. So if I factor in that extra surcharge I have to pay, yes, while it's frustrating, but if I look at the profit and the money that I can make over that long term period, and I can spread that extra cost over that period and still be making a good sum of money with my asset, then I'm not really going to be affected. Now, some investors will have to get over that and may struggle to at first because they're used to obviously paying less stamp duty, and nobody likes paying more, let's be honest, especially when it's a tax that you don't, you aren't able to claim it back at any point. You can't, when you sell, get it back. So it is very frustrating in that way. But yeah, it's just one of those things that investors will get around. It will become the norm. People will factor it in with their numbers, and it will just move on as it has done before. And just to finish on again and summarise that, I think it'll have more of a negative effect because you're going to reduce the rental stock, and less stock for renters means potentially higher rental prices. Okay, so look, I think overall that's the autumn budget. Didn't really faze me, shock me that much. I was a little bit surprised. I thought there would be more in there, which, would affect the property market. But overall, it was quite a placid one. Bar the stamp duty, which was a big announcement, but not massively unexpected. It didn't really faze me that much, the budget. It hasn't put me off investing, hasn't made me think that the property market's in jeopardy. I think it's just a pretty neutral one, if I'm honest. I think it's an easy one to navigate. It's going to not really change the property market that much. There'll be a few adjustments, of course, with the stamp duty, but apart from that, it should be all pretty straightforward. Now, if you think differently, feel free to reach out to us at Track Capital or at the podcast info at trackcapital.co.uk and let us know your thoughts. It's really good. We've been having quite a few listeners reach out, with questions, with feedback, and yeah, just general conversational stuff, which has been really, really good. So feel free to reach out. It'd be good to get your thoughts on this subject. How are you taking the autumn budget? Are you an overseas investor who's now going to be, factoring in this extra 2% surcharge added onto the 2% surcharge you're already getting charged. But yeah, hope that summary of the autumn budget has been helpful. And again, just to summarize, I don't think it's, a budget which is anything scary. I think it's pretty normal. And look, if the economy carries on as it is, inflation coming down, wages rising, the economy starting to really stabilize and also have a positive outlook, the property market should naturally follow suit as well. And since this announcement, we haven't seen any, massive changes to the economy or the markets react in a negative way. It's been pretty placid. So from that point of view, we can look positively towards the next few years for the property market. Well, thank you for joining me on this episode. As I mentioned, look out for the upcoming episodes where we will have guests as well. And then the other episodes that we have with just me on here, the podcast team have got some exciting stuff for me to go over. So do look out for those. Thanks for joining me again, and I'll see you in the next one. Bye-bye.